Hello, welcome to chapter 6. Let's go ahead and continue with merchandise inventory. So, we talked about how merchandisers differ than those that provide services in the last chapter. And now we're going to continue and talk about how we inventory that merchandise, right? So, this is something we don't have to do when we're a service industry. We have things like supplies that we may inventory, but we don't have an inventory of merchandise, right? This is something that's particular to companies that merchandise or sell products, or also manufacturers that have to merchandise. We'll talk about those later, but they fall in that same category that you have something that you have to inventory. And one of the things we need to examine and to explore is how do these companies inventory and why that matters. And so let's talk about those things. Let's go ahead and talk about the different sections we're going to be covering. In the first section, we're going to be identifying accounting principles and controls related to merchandise inventory. In the second section, we're going to account for merchandise inventory cost under perpetual inventory system. So remember, perpetual inventory system is the inventory system that keeps a running balance, right? So this is things that big companies that we already know. Any place that you go where they have a barcode system and you scan items, that is a perpetual system. It is keeping an up to date inventory. It's telling you what is available right now, or at least it tries to, right? Excusing for damaged goods and goods that are stolen. That inventory system is keeping an up to date system. Section 3, we're going to compare the effects on the financial statements when using different inventory costing methods. So, we're going to see why it's important and why different companies choose different methods to account for their inventory. And 4, we're going to apply the lower of cost of market rule to merchandise inventory. This is something you have to do that is mandatory amongst merchandising companies. And we're going to see why and see how that works out within our books and how you take account for that. In section 5, we're going to measure the effects of merchandise inventory errors on financial statements. What can happen if we enter an error or we calculate something incorrectly? And 6, we're going to use inventory turnover and days sales and inventory to evaluate business performance. These are things that are very important to different companies, especially if you have, depending on the inventory, like the merchandise that you're selling. But we do not want to keep inventory on the shelves too long where they become irrelevant, where they become expired, this is very important for companies like food companies and even retail clothing companies. Fads and different trends are going off at different times, and having inventory for too long can really cost you a lot of money. Account for merchandise inventory in section 7, we're going to look at account for merchandise inventory costs under periodic inventory system. So that's going to be appendix 6A, and we're going to look at how the periodic inventory system is differs from that of the perpetual system in some ways. Not in all ways, but in some ways it differs. So let's go ahead and go into 6.1. Identify accounting principles and controls related to merchandise inventory. So what are some of the things that we do? What are the accounting principles and controls that relate to merchandise inventory? So the first thing is accounting principles help accountants classify and report items on the financial statements. The accounting principles associated with merchandise inventory are consistency, disclosure, materiality, and accounting conservatism. So these are things that we need to pay attention to when we are talking about merchandise inventory. This helps when we talked about accounting in the first chapter. We talked about how it's not so rigid rules, right? We have some leeway in how we interpret some things and how we do some things. I don't know about you, but I'm a nerd when it comes to this kind of stuff. And I'm look at social media and I look at different accountants that post different things. There's all these different experts that talk about you can do this with your taxes and do that. And they argue back and forth, right? They're like, oh, you can't do that or you can't do this. And the reason that they argue and the reason that they can do that is a lot of things are depending on what stance you take and how you read the regulation and how you think you can defend it. You can take different stances, and you can see that as I've worked in different accounting firms. You can see that different accounting firms. I've been some accounting firms where the rules were very strict and regulated, and they were different regulations we upheld as being to the strictest point. And then I've had other firms where I'm like, there's some leeway there. We think we can defend that. We think that this applies to us and we can interpret it this way and it'll be more beneficial for our client. And if the IRS wants to talk to us about it, we'll go ahead and discuss that with them, right? They're willing to defend it because they read the regulation in a different way. And so this is some of the things that guide us are these four things: consistency, disclosure, materiality, and accounting conservatism. Now, let's go through these each one at a time. Consistency principle. The consistency principle states that a business should use the same accounting method and procedures from period to period. This is important, right? Consistency helps investors and creditors compare financial statements from one period to the next. This is very important because you want to be able to have comparable financial statements. If I did something a certain way in one period and then changed it in the next period, that could totally change the outlook of my company. We're going to talk about how these different inventory processes affect our net income, affect our inventory and our assets. This is something that if I change from period to period and I'm not consistent, they're not comparable and I can't get a just on how well my company is doing if I don't stay consistent. So usually when a company stays and they choose a certain pattern how they're going to account for their inventory, they usually use that certain way of doing it throughout the full life of the company. Now, one thing with that, if you're going to go when you go into advanced accounting, you're going to learn the repercussions when a company does decide to change. They can, it's not set in stone. They can go back and change, but there's a lot of things that come with that, a lot of cost, a lot of changing to prior books and things like that that a company has to show if they decide to change. So when you are first deciding how you're going to account for your inventory, it's very important that you make the right decision or you make a decision that's going to suit your company that you think is going to be not only good for you right then and there, but for the long term of the company. If changes are made in the accounting method, these changes must be reported generally in the notes to financial statements. These are things that need to be applied to the notes if changes are made, and then it goes beyond that, right? You're going to learn in advanced accounting that if you do make full changes from, we're going to talk about it later, FIFO to LIFO or LIFO to FIFO or something like that, that there's more than just notes. You have to actually change certain, you have to go back and recalculate your prior earnings and your assets and all those things from the prior for maybe 3 years prior. I forget what it is now. It's been a while since I've taken the exam. But these are things that are going to be repercussions of changing. The disclosure principle. The disclosure principle states that financial statements should report enough information to outsiders for outsiders to make knowledgeable decisions about the company. Information should be relevant and have faithful representation. So, if you're ever wondering, should I keep this? Should I write notes? This is when doing auditing and looking at audits. This is one of the things that they try to put as much notes and disclosure in the forms as possible because they want other people to understand what they're doing and why they are doing it. And it's also not only just for outsiders, also good for the company itself, right? Some people don't stay in the same position forever. A lot of companies change positions, they change accountants. Accountants move up, right? And so when you're making transactions, you're doing certain things, it's better to leave disclosure not only just for those that can understand it from the outside, but also from those in the company themselves. That your predecessors can come in and look at what was done and base their new transactions and things like that on what you've on the transactions and journal entries that you've made in prior. The materiality concept states that a company must perform strictly proper accounting only for items that are significant to the business financial situation. Information is significant when it would cause someone to change a decision. And I like the example they give. For example, a material, $10,000 is material to a small business with sales of $100,000. However, $10,000 isn't material to a large company with annual sales of 1 billion. If you're a small corner store that your mom and pop shop that sells trinkets or does specialty t-shirts or something like that, a $10,000 change is something that is very material to you. If you're selling $100,000 in materials every year and you lost $10,000 worth of inventory, that is something that you need to make sure that you put into the notes and that you explain about that. You're trying to anything that's material to the company. But if you're Amazon and there's a 10,000 loss somewhere or something, really there's no explanation that needs to be made. You're in the sales of billions of dollars, and a $10,000 transaction is really not going to affect anything that you do for the rest of the day. They probably have $10,000 losses every day and are things that they've had to do, and it's not really material. It doesn't affect the company. Shareholders aren't really, and I know that seems like a lot of money to us, but there's so many more transactions and so many bigger things that are material that need to be. There's so many more things going on that these things don't need to be explained, and not every $10,000 transaction needs to have a lot of notes behind it. Conservatism means a business should report the least favorable figures in the financial statements when two or more possible options are presented. So this is we try to keep our books as as accurate as possible, right? But we always err on the things that are not going to be favorable to us. So if there's predictions like anticipate no gains but provide for all probable losses. If there's a sell or something like that where the company can make money or can do things, right? You can anticipate and you believe that the company is going to profit on that. You shouldn't go ahead and include that in the books until it's earned, right? We don't anticipate revenue until it's earned. But if there are probable losses from doing things, you will anticipate those. You will make sure that you record those. Record an asset at the lowest reasonable amount and then liability at the highest reasonable amount, right? So those are the things until, like, if you're going to have an accounts receivable or accounts payable and you know there is a discount, you do not anticipate that the discount will happen until you've already made that payment. So you put it down accounts receivable or accounts payable at the full price until you receive the discount. Then you enter that in the transaction when you journalize that transaction. When there's a question, record an expense rather than an asset. Choose the option that undervalues rather than overvalues your business. These are just conservative ideas to make sure that you don't overstate anything. You don't try to, because you can get into a lot of gray area when you do overstate and you do show that you always err in the favorable side of things. And that can really give you a lot of that would give you a lot of change later on. And you always want to you always want things, if things don't go out the way that you would like them to happen, that you already show that. But if you do make a profit, if you do get a receive, you do end up having an asset rather than an expense, then it's favorable towards you in the end and you make those changes as it happens. So, control over merchandise inventory. Good inventory controls ensure that inventory purchases and sales are properly authorized and accounted for by the accounting system by ensuring inventory is purchased with proper authorization, right? Tracking and documenting receipts of inventory. This is something that a lot of this is done electronically, but it's important that you do it. Recording damage inventory properly, making sure that's done not only properly but quickly to make sure that you reach out to the supplier or the vendor that you purchased it from. Performing physical counts inventory annually. This helps us understand how much is being either damaged and lost or how much is being stolen and gone missing. Recording and removing inventory from merchandise inventory when sold, right? That way we don't have to double account for it, or we are not missing sales, right? That or we're not accounting for inventory twice, right? So if we record it as a sell in a perpetual system, we also need to record the inventory that's being removed from our accounts. And that way we don't go back and when we do a physical count, count that as losses or stolen goods or damaged goods, right? And so that way we're taking in revenue, but then we're not also accounting for that same inventory as a loss or damaged. So, data analytics and accounting, inventory is one of the most important assets for merchandising and manufacturing companies. Businesses can evaluate their inventory by using data analytics tools. Example, and here's some of the things, and this is only getting better with AI. So AI start not only to grab this information, analyze it, and make predictions, it's starting to go out and it do this on a regular basis, right? So before you'd have to have different algorithms, different software that would keep this. Now that software is getting more intelligent by the day. So Airbnb has collected over 1.5 petabytes of data on vacation habits and accommodation preferences of its customers. Analyzing this data helps identify areas and cities that don't have enough listings. So this is one of the ways now they can not only help identify a lot of companies like Uber do this, right? Analyzing data helps identify areas. So when they can not only do it, but they can like Airbnb, they can do it and they know during certain seasons. And this also helps them with AI. Now they can anticipate, say the World Cup is coming to town, they can anticipate based on what they've seen before and what predictions of like how many seats are going to be taken, how many, and they can even get into how many people are buying tickets from out of town and then anticipate how much new Airbnbs they're going to need in that area. Dickey's Barbecue Pit examines data about its inventory, meat, and sides at each of its 500 locations every 20 minutes using data analytics software. Keeping track of real time data allows Dickey's to sell excess inventory and avoid spoiled food. So, this way, they can, instead of having to toss out the extra food that's going to spoil at the end of the day, they can send out a text message and say, hey, we have ribs on sale for the next 2 hours. Come till they're sold out, or come and try our burn ends or something like that. Something that they're going to have on the menu or in their inventory that's going to expire, that they're going to lose money on. And one of the things we talk about in economics is when do you take a loss? When do you not decide to sell? When do you not decide to open up something? And so in this predicament, you're going to end up losing that. The food's already made, everything's there. You're going to take it as a loss and selling it for whatever price. It's already a sunk cost. The food's already prepared. Might as well sell it to get any money back towards the fixed cost than it would be if the food's already made and there's no variable cost there. Selling it or almost giving it away is better than not than throwing it away. So learning objective 6.2, account for merchandise inventory costs under the perpetual inventory system. So how do we do this, right? How are merchandise inventory costs determined under perpetual inventory system? So how do we account for that? There's a certain couple ways, right? Ending inventory. So we first look at ending inventory. That's the number of units on hand times the unit cost. So that amount is what we're going to be placed in our ending inventory. Cost of goods sold are the number of units sold at unit cost. But we have to we calculate this in two different ways, right? Getting our ending inventory, right? And we're going to talk about how we account for those in different ways to get that ending inventory number. At the end of the period, count the units and ending inventories, assign dollar amounts to the account. At the end of the period, determine the units sold during the period and assign dollar amounts to cost of goods sold. We can account for those in different ways, especially now. Let's look at this example here. In this example, we have a very simple way to do this because our cost per unit does not change. So all we have to do is start adding up how many more units we added are purchased, and then that adds to times whatever the unit cost per unit is. Since that cost per unit doesn't change, we always know that we have $350 per unit, and it's just always how many units we have times the $350, right? And so we start off with 2 units with $350, and then we add 4 more units. We have 6 units at $350. We sell 4 units, so we only have 2 units at $350. And then we purchase 12 more units at $350, and now we have 14 units at $350. And then we sell 10 units, so that leaves us 4 units at $350. And so at the end, we have 4 units, right? We purchased 16. We started off with 2, so that gives us 18. We sold 14. That leaves us 4 at the end. And all those units, their value, so would be $350. So our ending inventory would be 4 times 350, which would give us $1,400. Now, referring to Exhibit 6.1 in the prior slide, Smart Touch learning cost per unit remained $350. Ending inventory and cost of goods sold are calculated as such. Ending in merchandise inventory, number of units on hand times unit cost. So we know this one pretty easily because the unit cost didn't change. So we have 4 units times 350, $1,400 is our ending inventory. Cost of goods sold, number of units sold times unit cost is very easy as well because we have $350 as our set price. We sell 14 units at $350 per unit. That gives us $4,900. So we know what our cost of goods sold is. Now, we have different ways to account for inventory, and we're going to start talking about those here. But how are merchandise inventory costs determined under a perpetual inventory system? When the costs are different for different groups of inventory. So, this is where we have to start looking at when inventory enters, when we purchase certain merchandise, and how much, if that merchandise cost changes, right? And how many of those items do we purchase at that price? So here in the perpetual inventory record, we're looking at how much we purchased and then how much we purchased, how many items we purchased and how much those items cost per unit. So we start off with 2 units at $350. We purchase 4 more at $360. We sell 4, we have 2. Then we purchase 12 more at $380. We sell 10, we are down to 4. Now, determining on how we account for our inventory is going to determine what the value of those 4 last units are. So let's see the different ways we're going to do this. An inventory cost method approximates the flow of inventory cost in the business that is used to determine the amount of cost of goods sold and ending merchandise inventory. There are 4 basic inventory costing methods allowable by GAAP. Specific identification, we're going to talk about 4 of these. First in, first out. Last in, first out, weighted average. So let's talk about specific identification method. This is the first one we're going to talk about, and it's done with inventories. This is an inventory costing method based on specific cost of particular units of inventory. This is where you can have, and they give good examples here. You have automobiles, jewels, real estate, things that are very specific that are not you can are easily identifiable, right? Although cars may look exactly the same, may have the same color, maybe even have some of the same features, but they're easily identifiable and that they have a VIN number, they have other serial numbers on them. The VIN number is the easiest one to recognize. But that item is specifically identifiable. So you want when you have specific identifiable items, this method is the easiest to account for. Like real estate, not every house is built the same, and it's easy to identify because you don't have multiple houses on the same location, right? So even if the house is built specific, right, and placed in another area, and it's the exact same house, it still has a specific address. And jewels as well, diamonds can be specific based on their shape, color, and different defects. They are easily identifiable. So when you have specific identification, let's just say that when we have these units, we would have 2 units, 350. Let's say that each unit, the way we would do this in a way that the units are specifically identifiable is that each unit would have its own specific barcode. So we would be able to know which 2 units we purchased at 350, which 4 units we purchased at 360, right? And let's say we sold 4 units and we buy their barcode knowing exactly tracing that specific unit as we sold it. We know that one of the 350 sold and 3 of the 360 sold. So we know exactly which ones are being sold and we know how many units are left. We have 1 unit of each left over. So we know exactly what our inventory on hand is because we know the exact unit. We're able to identify that specific unit. 12 units times 380. So we would be able to identify, we bought 12 more units at $380, and we're able to identify all 12 of those specifically. We sold 10 units, and by specifically being able to know which units were purchased, we sold 9 of the 380, the ones that we purchased for $380, and we sold one that we purchased for $350. This would tell us exactly what we have on hand. We would know that exactly we have one unit that we purchased for 360s left, and 3 units that we purchased for $380 left. And that would tell us our specific amount of inventory on hand at the end. So our ending inventory. This is pretty tough because you have to have specific identifiers for each product. This is hard for companies to do because that takes even more computer processing, more packaging. You can't, when you put a barcode on an item, you would have to make each item box or each barcode different, right? And if you and from each other, right? So even if it's an item that's being duplicated and there's no distinguishing features except for that barcode, you would have to put in more effort for that. So a lot of businesses don't do that. They don't specify each unit. They just make a general barcode to identify the units in general. Let's discuss the first in, first out method. So the first in, first out method assumes the first units purchased are the first to be sold. So everything that you purchase is pretty much sold in the order that you purchased it in. Cost of goods sold is based on the oldest purchases. Ending inventory closely reflects current replacement cost. Now, cost of goods available for sale is total cost spent on inventory that was available to be sold during that period. Now, this isn't a perpetual system, so when there is a purchase being made or a sale being made, we always go to what is available to be sold at that time. And so we go to the earliest available, the first in available at that time is what's going to be accounted for. Let's look at some examples. So in this example, we have 2 units at $350 to start off, and we purchased 4 units at $360. We sold 4 units, and with doing first in, first out, we would first sell the 2 $350 units and then 2 of the $360 units. This would give us a total cost of $1,420, which would leave us with 2 units at $360, the value at $360 a piece. That would give us a balance of $720 of inventory on hand. From there, we purchased 12 units at $380 and sold 10 units. First in, first out says we always have to sell the units that we purchased first. So we have 2 units at $360. Those are going to be first sold. And then we would have 8 units at $380 sold, which would give us a total cost of $3,760. Since the units that were purchased at $380 were sold or purchased last, that's what we would account for or value the last 4 units at $1,520. So first in, first purchase is always first sold. Okay. So when we're doing FI or first in, first out, that is how we do it. Now, amounts unique to FIFO are in blue. So first amounts that you would show are the cost of goods sold. We would first do the 350 and then the 360, and then we would do the 360 and then the 380. The next method we're going to be discussing is last in, first out. So this is going to be the opposite of what first in, first out is. Last in, first out is inventory sold. The cost of the newest item in the inventory is assigned to each unit as a cost of goods sold. Cost of goods sold closely reflect current replacement costs, and in inventory contains the oldest cost. So this is going to be the opposite. So we're always going to sell what we had purchased last, right? And remember, it's always in perpetual system, it's always what's available. So let's look at their example in the next slide. So we sold 4 units. We had 2 units at $350 and we had 4 units at $360 at that moment. We are going to go ahead, since we purchased the $360 units lastly, those are going to be the ones we sell first. So we're going to count for those 4 units at $360. That leaves us 2 units at $350, which gives us a total inventory at hand $700. When we make the sell for the 10 units, we purchase 12 units at $380. When we sell the 10 units, we're going to use 10 units, or we're going to account for 10 units at $380 since those are the last ones we purchase and have on hand. So that's going to give us a cost of goods sold at 3,800, and it's going to leave us in our inventory 2 units at $350 and 2 units at $380, which is going to give us a value of 1,460 for our inventory on hand. And the amounts unique for LIFO are the cost of goods sold here. Since we are doing the latest, it would be $360. And for those first four that we sold, and then the last 10 that we sold would be 3,800 because that's going to be 10 at the $380. The last one we're going to talk about is weighted average method. So the weighted average method computes a new weighted average cost per unit after each purchase. This way, we finally go somewhere in the middle, right? So, weighted average cost per unit is determined by dividing the cost of goods available for sale by the numbers of units available. So, weighted average equals cost per unit equals cost of goods sold available for sale divided by number of units. So, we're just every time we take it in, we're just going to divide by how many units we have by the total cost we paid for our inventory, and then assign that to each one of our units. So ending inventory and cost of goods sold are based on the same weighted average cost per unit. Now, this does change as we go, right? So when we first start off with the 350, we purchased the 4 units at 360. We get a weighted average of 6 unit, $2,140 divided by 6 units gives us a weighted average at $356.67. When we sell those 4 units, that's what we're going to price them out as. Now, you may get a little bit of a difference. You see, I get 14, we have cost of goods sold as 1,427. We do that because we are rounding. That's a rounding issue. So you may get different numbers when doing the weighted average based on how you round. Then we have 2 units at 356.67. That gives us about inventory in hand $713. Now, when we purchase the 12 units at $380, we're going to take the 14 units and divide. We're going to take the 5,000. We're going to have $713 plus the 4,560, which gives us 5,723 divided by 14 units. Now each cost per unit, the weighted average per unit is 376.64. When we sell those 10 units, that's what we're going to then post those as 376.64. We get rounded to 3,766, and then that gives us our 4 units. That's where we're going to value them at 3,000 or $376.64. Every time we make new purchases, we need to calculate a new weighted average, especially if that purchase was made at a higher price. So after each purchase, Smart Touch Learning computes a new weighted average cost per unit. For example, August 5th, when it did purchase those 4 units at the $360, we now get a $356.67. Under the weighted average method, cost per unit is a weighted average. You cannot take the average of the 2 unit cost, 300, 350 and 360 to determine the new unit cost. Instead, you must use the total cost of goods available for sale to 2140 divided by the number of units available, both 6 units. This is because we're taking the weighted average. When you purchase more units at a higher cost, that has a higher weight. The cost of goods sold on August 15th is calculated using the weighted average cost of 356.67 per unit. Now, on August 26th, when the next purchase is made, the new weighted average unit cost is as follows. So now we're going to take the 713 that we had left over. That's our cost of goods sold plus the new 10 units that we purchased, right? Or 10 units, 12 units that we purchased at $380 gives us 4,560. And we're going to divide that by 14 units. And then it's going to give us $376.64. The weighted average cost summary at August 31st is as followed: 14 units that cost a total of $5,193 divided by the 4, it gives us a total of units that cost a total of 1,000. And then, okay, so That gives us a total of each one of those units equaling $376.64. And then our ending inventory, we would take the 4 units times the 376.64 rounded, we get $1,507. The amount's unique to the weighted average. We have method shown in blue. Here, cost of goods sold, that's going to be unique. If we do the weighted average, if we do FIFO, we do LIFO, those are going to be different amounts. And then the cost of goods sold at the bottom, the 10 units that we sold there, that's going to be different as we do the weighted amounts. Now, why would a company choose to either do FIFO, LIFO, or weighted average? And we're going to talk about what is the difference between those three and why they would choose to do one of those methods. So we're going to compare the effects on the financial statements when using the different inventory costing methods. So, what happens to the income statement when we use these methods? The income statement, cost of goods sold, is higher under LIFO than under FIFO when costs are rising. So, if we are taking out the latest cost, if they're rising, that's going to make our cost of goods sold higher because we're taking in higher amounts. Net income is lower under LIFO than under FIFO when costs are rising, right? So if our cost of goods sold is higher, that's going to be higher expenses, then that's going to also lower what our net income is. Balance sheet, when costs are increasing, FIFO inventory will be the highest, right? So our assets would look better when we have FIFO, but our LIFO inventory will look lower because we're taking those first amounts. If the costs are rising, then we're keeping those first amounts and expensing the later amounts. Our balance sheet, our inventory is going to look like very low compared to when we were at FIFO. So LIFO is going to make our asset inventory look low. FIFO is going to have that a higher amount. In the income statement, we're going to have higher cost of goods sold under LIFO, which is going to give us a lower net income. And FIFO, we're going to have costs are lower, and that's going to give us a higher net income. So comparable results for specific identification, FIFO, LIFO, and weighted average income statement. So let's look at our income statement. We have net sales. That doesn't change. We sold each one of our units for $500. So under all three specific ways that we account for inventory, we're still going to have $7,000 of revenue. Now, where the change is the cost of goods sold. With specific, we get 5,200. With FIFO, we get 5,180. With LIFO, we get 5,240. And with weighted average, we get 5,193. FIFO is going to give us a higher gross profit than LIFO because its cost of goods sold is less. And weighted average is going to be in between both of those because we're taking the average of all the purchases that we've made. Specific is can be either higher or lower depending on it could even match FIFO, it could match LIFO, depending on which items are being sold, right? If the first items are always being sold first, then it's going to match FIFO. If the items that are recently purchased are always being purchased first, then it's going to match LIFO. If it's somewhere in the middle, it can be in between. It'll be in between of those, just like it is in this example, and be closer to weighted average. Now, let's look at comparable results for specific identification, FIFO, LIFO, and weighted average balance on the balance sheet. Now, where we're going to see a big difference, or not a big difference, where we'll see the differences are, and is the ending merchandise and inventory. Because cost of goods sold is going to be a bigger amount with FIFO or with a LIFO, it's going to have a smaller ending inventory. FIFOs will have a larger ending inventory, which gives us a greater asset. And then weighted average is going to be in between those two, and specific identification can flux between all of those. So, period of rise in inventory costs on the income statement, specific identification varies. FIFO is going to be your lowest on cost of goods sold. LIFO will be your highest, and weighted average will be in the middle. Net income varies. You're going to have your highest net income when it comes to FIFO, your lowest net income when it comes to LIFO, and you'll be in the middle with weighted average. Your balance sheet and in merchandise, which is an asset, is going to vary with specific identification. It's going to be your highest with FIFO, your lowest with LIFO, and somewhere in the middle with weighted average. If you're getting a period of declining inventory costs, as costs go down, those things are going to reverse. Specific identification, the cost of goods sold will vary as usual. FIFO will be the highest cost of goods sold. LIFO would then be the lowest cost of goods sold, and weighted average will still be in the middle. Net income will vary for specific identification. FIFO will be now the lowest, LIFO will be the highest, and weighted average will be the middle. The balance sheet or ending inventory will vary with specific identification, but FIFO now instead of the highest will be the lowest. LIFO now will be the highest instead of the lowest, and then weighted average will be in the middle. Now, there is a thing called a lower of cost or market rule to merchandise and inventory. Now, this is a rule that you need to be aware of just in case the value of your inventory does decline to lower than what you've paid for in cost. So lower of cost or market rule requires that the inventory be reported in the financial statements at the lower of the inventory's historical cost or its market value. Market value generally means the current replacement cost. So this can happen a lot in technology. Say you have a computer chip, a computer, or some kind of thing that's being outdated. Maybe it's a phone, right? And there can be a point in time when you bought that inventory and you purchased that inventory and you bought all these different items and units, like say phones or computers or computer chips, and that was the latest and greatest at the time. And you paid a premium to put it in to sell it to your clients. And let's say that those things didn't sell as quickly as you'd like. And as it's going, technology is advanced, and now there's better phones. Now there's better laptops, better computer chips. And now those computer chips are high in demand. The ones that you carry now are low in demand and do not sell and cannot on the market or have dropped significantly in value. Now you have to report your inventory at the market value. Let's say that you had phones, and all of a sudden you decided to go ahead and release the next phone. And the phones that you have on hand, you paid $500 for, but the market value for them now is $450. Now you have to, because the market value is less than what you've actually paid for it, of what your cost was. Now you have to go back and value that at $400 or $450. So here's an example. Smart Touch Learning paid $1,000 for the Tab 053 inventory. By December 31st, it can be replaced for only 2,200, and the decline in value appears permanent. So all of a sudden now they can purchase that and it can be replaced for only 2,200. The market value is declined under what they had paid for that inventory. So now they have to value the inventory at its market value. The cost of goods sold, now we have to increase cost of goods sold, which is going to be an expense. That's how we're going to expense out that loss, and then merchandise inventory will then be credited because now our inventory is going to be worth $800 less, and we're going to downgrade or deduct or reduce our inventory by the $800. So that's the journal entry that you would make. Cost of goods sold, $800 debit. Merchandise inventory, $800 credit. To write merchandise inventory down to market value. So we're increasing our expenses, cost of goods sold, and decreasing our inventory, which is an asset. So Smart Touch Learning Balance sheet would report this inventory as follows: current assets, merchandise inventory, 2,200. This is to reflect that you are being objective and showing what your value of your inventory actually is. Note one, statement of significant accounting policies. Merchandise inventory. Merchandise inventories are valued at lower of cost or market. Cost is determined using the first in, first out method. So this is a note that would be placed in your financial statements to show that this is the reason this expense was taken, and to show that this is why you have this entry in your financials. Now, let's measure the effects of merchandise inventory errors on the financial statements. It's very important that we don't make errors, but what can happen if we do? We've already seen that by using the different methods, we are going to affect the income statement and the balance sheet at the very least. Now, what happens if we put this information in, put in errors in this information? What kind of effects are they going to have on our financial statements? An error in inventory can lead to errors in other related accounts. Because of the ending inventory number is used in other computations when ending inventory is incorrect, the other numbers will go also be incorrect, such as cost of goods sold, gross profit, and net income. So if we overvalue or undervalue our inventory numbers, we can cause our gross cost of goods sold to be off, our gross profit to be off, and our net income to be off. The following shows how an overstatement of ending inventory affects cost of goods sold, gross profit, and net income. So here we have net sales is correct, and then we're going to calculate our cost of goods sold. So we begin with our beginning merchandise and inventory, right? We take a physical count, we go and we count up our beginning merchandise inventory. We have that correct. And then we add all the net cost of purchasing inventory purchase. So all the net cost of purchased inventory, which is going to be what we purchased in merchandise, plus we have to add and subtract all the other things like discounts and shipping and all those things again. So now we have the net cost of inventory purchase. We're going to add that and we get cost of goods available for sale. So we started with inventory, added all the inventory that we purchased throughout the year. Now we have what is available for sale. Now, let's say we did ending merchandise and inventory and we created an error. We overstated it by $5,000. So we overstate the inventory, right? So that makes our cost of goods sold overstated by $5,000. And then that overstates our $5,000 or overstates our gross profit. Operating expenses are going to be correct, and our net income is going to be overstated by $5,000. So if we say we had $5,000 in merchandise and inventory, that's going to overstate our cost of goods sold, it's going to overstate our gross profit, and overstate our net income. Now, if Smart Touch Learn understated the inventory by $1,200, the effect would be shown here. Same thing, if we understate our cost of our ending inventory, right? Instead of saying we had $3,200, we say there was only $2,000 in the inventory. Now our cost of goods sold is going to be understated by $1,200. That's going to understate our profit by $1,200. Operating expense will be correct, and then net income will be understated by $1,200. So here's some numbers to show you how this will work out. Say we have net sales and revenue of $100,000. We started off our inventory with $10,000, and then we purchased $50,000 of inventory throughout the year. That gives us $60,000 that we could sell throughout the year. When we count up our do our inventory at the end of the year, we find that we have $15,000 on hand, which is incorrect. We overstated it by $5,000. We only have $10,000 of inventory on hand. So cost of goods sold, you'll take your 60,000 minus your 15 and we got 45,000, which should be 50,000. Right? So cost of goods sold should be 50,000, it's understated by $5,000. Then you would have instead or it's overstated by $5,000, right? And then should have 50,000. Now your gross profit is overstated, right? You got 100,000 should be minus 50,000 should give us a gross profit of 50,000, but no, that gives us a profit of 55,000. So now we're going to have one period where we have an error where we have $55,000 in gross profit when we should only have 50. And that error is going to continue to the second period because we're going to take that starting our last ending merchandise is going to be our starting merchandise in period 2. We have 15,000, 50,000 in purchased inventory, and it's going to say we have $60,000, $65,000 of good available for sale. This is overstated, right? So $15,000 is overstated. Our beginning is overstated. Our cost of goods sold available for sale is overstated, and that gives us $10,000 cost of goods less any merchandise. Now the $10,000 is correct. If we went, let's say this time we went and they did the inventory, and yes, it's stated correctly. We have $10,000 in the merchandise. So now we have the $55,000 sell or $55,000 cost of goods sold, which is going to be overstated because we only should have had 50, right? Because our cost of good available for sale was overstated. So we should only have 50. Now we have 100,000. Our gross profit is going to be understated and our net profit will be understated because we should have $50,000 in gross profit, not $50,000 in or $50,000 in gross profit, and then we should have a net higher net income at the end. But this does correct itself by period 3 because we did correctly state that $10,000 was the ending merchandise and inventory. So the next year in year 3, we would have $10,000. We would add the $50,000 that we purchased, get $60,000 goods available for sale, do our count, our inventory count, get $10,000, and then that would correctly state that our cost of goods sold was $50, 50,000, and we would correctly state that we had gross profit of 50,000. So one error can go and take on it would have errors, carry that error on for at least another period, and it would be until the third period that error is corrected. Now, the effects and inventory errors. Period 1, ending merchandise inventory overstated. In period 1, cost of goods sold is going to be understated, and gross profit and net income will be overstated because we didn't take out as much, we didn't state as much expenses as we should. So our gross profit and net income are going to be overstated. And period 2, cost of goods sold is going to be overstated, right? And that's going to, since we're overstating our cost of goods sold, our profits and our net income are going to be understated. When inventory is understated, cost of goods sold is going to be understated, right? Because we understated our expense. So our cost of goods sold is going to be overstated. And then when inventory is understated, and then gross profit, net income are going to be understated. And then when cost of goods sold on period 2, cost of goods sold is going to be understated, and gross profit and net income are going to be overstated. So an inventory error cancels out after 2 periods. The overstatement of cost of goods sold in period 2 counterbalances the understatement in period 1. You can see that the opposite effect happens in the second period. By the third period, as long as we get the inventory count correct, it should correct itself. The whole thing is not to have this error in the first place. We have to be aware of what we're doing. So that's why it's important to make sure that our ending inventory is always correct. Using inventory turnover and days sales in inventory to evaluate business performance. This is something that a lot of outsiders will look at to see how well sales are going in the business. So the first equation we're going to look at, or ratio we're going to look at, is inventory turnover. So what is inventory turnover? Inventory turnover is cost of goods sold divided by average merchandise inventory. So what is average merchandise inventory? You take your beginning merchandise inventory plus your ending merchandise inventory, divide that by 2, and that tells us what your average was throughout the year. So the inventory turnover ratio measures how rapidly inventory is sold. So how many times did you turn over inventory? Let's say that you have an average of inventory on hand of 40 products, right? How many times did you turn over that ratio, right? You want something that's a higher number. That means you sell pretty quickly. The ratio should be evaluated against industry averages. A high turnover rate indicates ease of selling, right? Something that's selling very quickly, that you're able to sell all the time, and that you're able to flip. And that's important to outsiders because they can see you can generate revenue, generate cash. A low turnover rate indicates the difficulty of selling. But this is not always a bad thing, right? It depends on what industry you're in. If you're in the car industry and you're in the housing industry, those inventory turnovers are going to be, and you want a good inventory turnover, and it's if you can have a high inventory turnover in those areas, it's gonna be, very valuable, but most those industries are gonna have lower inventory turnover on average compared to something like a grocery store or a retail department store or something like that. Those inventories are turned over much more quickly because they're smaller items, they're lower cost items, and it doesn't take as they don't stay on the market as long as these other items do. Days sales and inventory. Days sales and inventory says takes 365 days divided by inventory turnover. What does this tell us? This tells us the days in sell inventory ratio measures the average number of days inventory is held by the company. So usually this is important because we have to see, especially if you have products that are going to spoil or have expiration dates, or that in technology that end up being outdated very quickly. This tells us how long these items sit on the shelves. And the faster we can get those items out, one, we're paying for less storage space. Two, we're not being left holding items that may be or no longer available for sale or no longer valued at a high price. For inventory with expiration date, this measure is very important. Yes. So, like grocery stores, you need days, sales, and inventory that has to be a low number, right? Food spoils very quickly, so you don't want something with 30 days in inventory. You want something that stays 2 days, 3 days, 4 days in inventory, the very lowest, right? Because you want to get it out of your store and on the shelves. Maybe some things have a long shelf life, but a lot of the things you want out of that store, you want it to be out of your shelves, so you do not take the risk of losing money on something that expires. So let's look at PepsiCo. This is going to be our example in this chapter as well. It says from PepsiCo's financial statements from the year ended December 25th, 2021 in the millions. Cost of goods sold, cost of sales is 37,075 million. Beginning merchandise inventory was 4,172 million. Ending merchandise inventory was 4,374 or 347 million. PepsiCo's inventory turnover is 8.7 times per year and is calculated as. So it takes the average, right? So between 4,172 and 4,374, that's where your inventory usually sits on average. If you take the amount of what you sold, your revenue, your cost of goods sold, your total cost of goods sold for the year divided by that average, then you'll get 8.7 times per year. So this says they've gone through their inventory 8.7 times throughout almost 9 times throughout the year. They've fully sold their inventory and restocked their inventory based on what their average inventory sits at. That's pretty good. They're getting it out pretty quickly. They're getting a good turnover. So if this was something we were looking at to see can they sell? Yes, they're selling their inventory almost 9 times over per year. We take that information, we say how many days does it sit from PepsiCo Corporation financial statement for the year ended December 25th in the millions. We have these amounts. So now we're going to take that inventory turnover and take 365 and divide it by the inventory turnover. Pepsi's days sales and inventory is 105 days and is calculated as 365 days divided by inventory turnover, so 8.7. So if you take 365 divided by the 8.7, usual lifespan of those products will sit 42 days. Given that soda doesn't expire that quickly, that's not bad, right? So I bet you they would like a high or lower number, right? They would like their products to sell once every 10 days to go through, get most of their products out within 10 days. But some products will stay longer, some products will stay shorter, right? So depending on what the product is, sometimes it flies off the shelf, sometimes, and depending on when the demand is high. So 42 days is not a bad average, I would say. But the only way we would know this is that we would take comparable competitors. So you would take Coke, you would take other soda brands and that also produce. It's kind of hard because most of the big conglomerates own most of the brands, but there are other soda brands out there that do compete. And I believe Dr. Pepper is still separate. So that you could take maybe those three and then see how long they sit every time and then see. who's been able to get a faster turnover. So let's look at accounting for merchandise inventory costs under a periodic inventory system. So we see what it is under a perpetual inventory system. Now let's look at a periodic. So perpetual, we're continuously updating our inventory as we make purchases and as we sell. Now we need to look at it and see how things are as we have the periodic that does not take in inventory. It has to do a physical count inventory on a either yearly basis, monthly basis, but this is not something that is being updated continuously. Under a periodic inventory system, inventory is not tracked in the accounting system continuously. The beginning inventory balance is carried until the end of the period. Purchases are accumulated during that period, and the ending inventory balance replaces the beginning inventory balance. So at the end of the inventory balance, then they take a physical count, and then we say this is what we have left, and then that's when we go ahead and account for what we have sold and add values to our cost of goods sold. So on a perpetual inventory record, changes in the cost per unit. So we can see in the changes of cost per unit changes as we purchase these different units, right? That goes through, and FIFO and LIFO are going to be calculated a different way. Under periodic inventory system, the company will calculate any merchandise and inventory and cost of goods sold at the end of each period during using the cost of goods sold formula. We start off with our beginning merchandise and inventory plus our net cost of inventory purchased equals our cost of goods sold available for sale. Indie merchandise and less our indie merchandise inventory gives us our cost of goods sold. So at the beginning, we had purchased inventory 700. Then we purchased units at 360 and 380. They gave us a total of 6,000. And so for this period, we have available for sale $6,700 of units. Now, with the first in, first out, any inventory will be calculated using the newest items in the inventory. Cost of goods sold will include the oldest unit cost. Beginning merchandise and inventory, we have 2 units at $350 plus 4 units at 360 plus 12 units at 380 gives us 6,000. We got cost of goods available for sale 28 units less ending merchandise and inventory 4 units at $380, right? And then cost of goods sold gives us 2 units, $350, and then 4 units at $360. And so since we sold 4 units, that should be the first, since the first are 4, less indie merchandise inventory. Okay, so yes. So since we calculate first in, first out, all we have to do is say how many units are left. After selling all those units, after we sold all those units, we're going to go ahead and say what's left. We have 4 units left. What was the last thing we purchased? We're going to assign that cost to those 4 units, 380. So that says that we have $1,520 left in inventory. So we take the $6,700 minus the 1,520, which gives us our cost of goods sold of 5,180. Now, this will be the same as for perpetual system because we are always grabbing the first ones. And so that doesn't matter when we grab it, but it does matter in the other two. And so in last in, first out, this is going to be a different amount. And the reason for that is that we do, as we're continuously updating the last in, first out in the perpetual system, there are going to be different amounts available for sale at that time. And since we're doing it in the periodic system, we're going to wait to the very end of the period. We're going to sell the oldest or the newest ones that are available at the end of the period. So let's look at it. And so ending inventory be calculated. So we began with 700, we purchased 6,000. We have a cost available for sale 6,700. At the end, we're only taking what was purchased at the beginning. So we're first in, first out. We have 4 units left. So we go to what's the first 4 units that we had purchased, and we purchased 2 units at 350 and 2 units at 360. or 4 units at 360. So that's what we're going to assign to those units that are left over because we sold all the last units to come in. And so our cost of goods sold is going to be all the last units. So we're going to sell all the 12 units at $380 because we sold 14 units. And the last units that we purchased were those 12 units at $380. So they're going to be gone. And then we're also going to sell 2 units at 360. This is different than what we had at the periodic because when we first made the first sale of 4 units, the only ones that are available for sale were the $360 units and the $350 units. And we ended up selling all 4 of the $360 units because there were no units available for sale at 380 at that time. This is going to give us a different amount when we are using the periodic system, and it's going to be higher. And in this case, it was $5,280. When if we can go back and we could see that LIFO was $5,240. So it's a $20 difference because we sold more units at $380 than we did at $360. Now, the weighted average cost per unit is calculated as followed. This is also going to be different because of that same reason, right? We have cost of goods sold available for sale period, number of units available. So here we're taking the $6,700, dividing it by the 18 units. That's what we had 2 units to begin with. We added the 6, we had 2 units, $700. We purchased $6,000 more of units. That gives us 18 units. We take the total divided by the total number of units. That gives us a cost of 372.22. And so 2 units from the beginning of inventory plus 16 units of purchase during August. And here we're just taking, we say, okay, we have $6,700. We had 4 units at the end. We're just going to take that 372 times 4, get our amounts, take it away from the 6,700. That's going to tell us how much we sold. That's going to be different as well because in the periodic system, we are updating the weighted average cost every time we make a purchase. And so you could see that the weighted average cost was different after we made the purchase of 360, and then it was different again after we made the purchase of 380 because we're continuously updating that system and have all that, we're continuously updating that system and it gives us a new weighted average every time we have a new sell. This in this example, we're just taking the total amount of purchases minus the total amount of units that we had purchased altogether. And that is it for chapter 6. If you have any other questions or would like to discuss anything, please let me know. And I would love to go over it with you and help you out in any way I can.